Hi everyone, I'm Paul and welcome to my review of lesson 33 and 34 of ICT's 2022 Mentorship Program. Today's video is going to be another 2-for-1 where we're going to be looking at ICT's trades on the 20th and the 24th of May. But before we do, if you enjoyed today's video, it would be great if you could like it because that helps other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. These are quick, easy and free ways for you to support my channel. Lastly, if you'd like to hear more from me and join a community of like-minded traders, then make sure you check out the link in my description, which allows you to subscribe to my free weekly newsletter and to join our Discord. Now that that's out of the way, let's jump into today's video. Today's video is a review of lesson 33 and 34 from ICT's 2022 Mentorship Program. Our outline for today's video is we're going to first talk about marking out the dealing range, and then we're going to jump straight in to the two trading examples that ICT covered in lesson 33 and 34, which is a trade on the 20th of May and another trade on the 24th of May. Now we'll start off today's video just by talking about how to mark up the dealing range. It's funny, it's something that's pretty simple, but I think I've made the mistake of doing it the wrong way more than once or twice. So I thought it'd be important to cover that first in the video because it was something that ICT actually added just right at the end of lesson 34. So when we're marking out the dealing range, the most important thing is to think about casting that projection forward. So we're trading in that direction, and so that's the direction which we should be marking out the dealing range. Now if we're looking at a long setup, we'd be casting that fib from the swing low to the swing high, and then obviously if we're looking for a short setup, we'd be casting that fib or the dealing range from the swing high to the swing low. And then if we're looking for a trade to go long, we'd be looking at price to come back into that discount, so under that equilibrium level, under that 50% level, and into a key area or a setup, so whether that's a fair value gap or an order block or whatever it might be, that's what we're looking for inside that 50% range. And then conversely, if we're looking for a short setup, we'd be looking for price to go into that premium part of the range, so above equilibrium, and again we'd be looking at a fair value gap or an order block or whatever it might be that you're using to actually enter your trade in that premium part of the array. So don't worry if that didn't make sense. We're going to go through two quick examples now, both a long and a short one. So we're going to start with a long setup. So you'll remember our first point is we're looking at casting our array forward. So we're looking at the swing low here, so we're going long. So we started at the swing low and we terminate it at the swing high. And so then what we're looking for is for price to come back in to that discount part of the range. So you can see we have our equilibrium level here, and you can see that's exactly what price does. It comes down and actually trades through that equilibrium level and goes deeper into the range. Now there's lots of ways that we can then look to get set in this particular example. So we could be looking at our traditional fair value gap setup. So we have our fair value gap right here, so our 1, 2, 3 candle formation, and you can see we have a imbalance right there at that 50% level. So that's what we would be looking for. So if we mark that out, I'll just make that very clear. We have our fair value gap there, and you can see price comes into that area before then trading higher. Alternatively, we could look at an order block entry. So for example, right here, and you can see we get the same effect. So the market trades back down into that discount part of the array. So we come below the equilibrium level, we touch into that order block, that bullish order block before trading higher. So that's how we would use our discount array in our long setup. So looking at our short setup now, it's obviously just the opposite of what we'd be doing for our long setup. So we run our fib or our array from the swing high to the swing low, and again we're casting forward because we're looking for price to come back into this area before trading lower. So you can see in this example, from this swing high to this swing low here, we have our equilibrium. We're sitting right inside a fair value gap just there. Now if I mark this out, this is obviously a bearish fair value gap. You can see the market trades back up into that, does it actually twice before then trading lower. So you can see price comes back up above that equilibrium level, so above 50% and into our premium part of the array. And then we can be looking at our fair value gap to then use that as our entry. And again, you're not just restricted to using fair value gaps, you can use any of the other entries that ICT teaches. It just comes down to what your model is. So we're switching over to our first trade that we're going to be looking at now, which is from the 20th of May, which is from lesson 33. So we're on the daily chart for the ES or the S&P. We've obviously been looking at this, throughout the last couple of lessons. So I'll just quickly review what we're looking at on the chart. So you can see that the market was clearly trending down. We took out this sell side liquidity down here, and this is where we switched our bias and we started looking for higher prices. So we were looking for price to trade up into these highs here and then up into this volume imbalance here. So you can see that's exactly what happened. After taking out that sell side liquidity, we started to seek that buy side liquidity. We took that out here with this candle, and then with this candle we then traded just up into that volume imbalance. You can see how we've reacted to that. We had this big outside day here, so we took out the lows of this candle, and then this candle. So then from the previous session, the 19th of May, so we had this like consolidation type of day. We actually have a volume imbalance here between the 18th and the 19th, and in the process of this move, you can see we've created this fair value gap here, or this imbalance just here. So going into the session on the 20th, our bias is bullish. We're looking for price to trade up into that fair value gap and also to fill this volume imbalance here. So let's zoom into our 1 hour chart now and start working through our setup for this particular trade. So looking at our 1 hour chart now, what we can see is that the market's traded up and around this volume imbalance that we marked out from our daily chart. We've then traded into a fair value gap that we've got here on our 1 hour chart, and that's also confluent with that fair value gap that we marked out on the daily. And in the process of that, you can see we've created these relative equal highs, this buy side liquidity just here. And as we came into the opening part of the session, so the equity open, you can see that this move here has broken market structure. So this was a key swing low that ICT was looking at and talking about during the video. And so this was the trigger that he was looking for to get into the market. He was ideally looking for a sweep of these relative equal highs up here back into these confluent imbalances before a trade lower. But really the key trigger for him was this swing low just here, and you can see immediately after that the market reacts to that. We trade lower, we take out the sell side liquidity here, the relative equal lows here, and we trade down deeper before reversing after the lunch session and then trading back up into this bearish fair value gap that was formed on this break of the short-term low just here. So let's zoom into our 15-minute chart now and start to put a little bit more structure around this particular setup. So we're on our 15-minute chart now, and there's a lot going on this page. So I'm just going to progressively work through it just to orientate ourselves. So we have our midnight open New York time just here, and we've just extended that out in time here. We have our 8:30 open, and again extended out, and our equity open here in blue extended out. So you can see that's the volume imbalance that we talked about on the daily chart. We have our fair value gap, our bearish fair value gap from the daily, and then our 15-minute fair value gap transposed here as well. So you can see the market is trading in and around that volume imbalance, and as we start to come into that 8:30 open, we trade into that fair value gap. Now ICT was looking for a sweep of this buy side liquidity, these relative equal highs here, so a punch higher first to take out that liquidity before the move lower, but we didn't get that. And so what he was really focusing on was this swing low here. You can see that's where we get this break in structure just here, and in the process of that you can see we have our fair value gap formed here. So 1, 2, 3 candles, there's a fair value gap formed there. Now this is the low risk ideal entry that ICT was ideally targeting. Now in this particular lesson he was walking through the trades he was taking with his son as he was coaching him, and they didn't actually trade in this one. They actually traded a bit lower, but this was the ideal trade that he was looking for, and we'll go through that in a bit more detail later on in the video. And you can see as the market trades lower, we get these displacements and these fair value gaps forming as we do, and all the way down right to this level just after lunch, where the market then turns around and trades back up into this fair value gap here, and then we retrace right back in to the dealing range, and you can see we come back up into this level here, which is just above this 62% level and under the 79% level, which is an optimal trade entry. And you can see we come back in to this bearish fair value gap, which is obviously confluent with those levels. Now in the process of the reversal, you can see we paint a bullish fair value gap just here. You can see we break structure, we trade back into that a number of times before reversing and going higher. Now, one of the interesting things that ICT mentions in the video, which I hadn't really seen before and he hadn't mentioned before, is how swing lows, often where we're marking out our sell side liquidity, is actually confluent generally with our powerful fair value gap setup. So you can see that's the swing low that he was targeting just here to participate into the market. And you can see if we draw this across, that's confluent with this fair value gap here. And then similarly, we've got another swing low here, so sell side liquidity there. If we draw that across, again, there's a fair value gap just there, and there's actually a setup here on this 15-minute chart. So if you'd been using the 15-minute chart here, you could have gone short here. You can see the market trades back up into that fair value gap twice before going lower. And then again, we have another fair value gap here, which is confluent with this sell side liquidity relative equal lows here as well. So in the next chart, you'll actually see that in more detail, but it's a little bit easier to see it zoomed out on the 15-minute chart here. So that's something I'm going to look at in my trading going forward, because I hadn't really noticed that. And now that I've seen it, it's one of those things you can't unsee. So let's zoom into the tighter timeframes and start to look at some of the executions that ICT took in this session. So we've zoomed into our 5-minute chart now, and this is probably a good time to look at how those fair value gaps align with those swing lows or that sell side liquidity now that we're on a better execution time frame. So this particular setup that we have just here, so this is that ideal entry that ICT would have been looking for after that swing low was broken. So this is that swing low that we had on the 15-minute chart. And this is the fair value gap we have on the 5-minute chart, which is confluent with the fair value gap we had on the 15-minute chart. So if I just mark this out now, you can see we have our bearish fair value gap just here. So you can see we break market structure there. We get our displacement. So this is our bearish fair value gap setup. So 1, 2, 3 candles, and you can see the market trades back up into that a number of times before finally breaking down and trading lower. And we're obviously targeting these levels down here, this sell side liquidity here. But equally, if we look across, we have these other sell side liquidity lines, which we've marked out from that 15-minute chart. And you can see how these again line up with our fair value gaps just here. So there's one here, and then there's another one just here. So these are just additional points which add confluence when we're looking to try and identify the best setup. So it's our fair value gap 1, 2, and 3. You can see the market then trades back up into that, and again before trading lower. And then similarly with this sell side liquidity, so there was actually relative equal lows here as well. Our fair value gap set up again, so 1, 2, 3. You can see we pull that out in time. We just touch it here before then trading lower. So we're looking now at the period after lunch. So you can see we have this continuation through the lunch period, and then the market reverses just here. So this is that fair value gap that we had from the 15-minute chart transposed down onto the 5-minute chart. And if we mark out our bullish fair value gap now, we can see how that is confluent with our 15-minute level. You can see we have our bullish fair value gap, so 1, 2, 3 candle formation, so between the high of the first candle and the low of that third candle. And you can see if we pull that out in time, then we trade into it a number of times before the market starts to trade higher. And you can see it's seeking this liquidity, the buy side liquidity that's residing in this fair value gap. So this is the one that we marked out from our 15-minute chart. You can see we have confluent imbalances on the 5-minute chart here. And so this is where price draws up into, it goes above that equilibrium level and up to our optimal trade level entry. Now, if we zoom down to our 1-minute chart now, we're actually going to look just in a little bit more detail into that optimal trade entry, or that low risk entry that ICT was looking at during the opening rotation after we broke that swing low. So this is that level here that we're looking at. So that's the swing low that's been broken here, and you can see we get this displacement down. So again, remember, we're on the 1 minute chart here, and this is our fair value gap just here. So I'll mark that out. It's obviously a little bit tricky to see, but you can see we've got our 3 candle formation. So 1, 2, and 3. And you can see the market then trades up into that level just here. And you can see we've broken market structure here. So there's a swing low here that we break there. Now this is the optimal entry, or the ideal entry, that ICT was hoping to get in this particular session. And you can see it still works, and it's obviously a bit tricky to see just here. But if you mark the dealing range from the swing high down here to the swing low, so remember we're casting that forward and we're looking for price to draw back in above that equilibrium level. This is what we talked about in the earlier part of the video. You can see we do that. That's confluent then with our fair value gap, and then the market instantly reacts to that particular setup and starts to trade lower, drawing down towards this sell side liquidity that we have down here. So we're back out on our daily chart again, still looking at the S&P, and now we're going to be looking at the trade from the 24th of May, which was the trade that ICT covered in lesson 33. So we've played obviously the market forward a little bit from where we were covering lesson 33, which was from the 20th of May. So you can see from that point, the markets then had this, again, outside day, this like spinning top. You can see we traded higher up into that bearish fair value gap. We've essentially balanced out that range. You can see how the high of this candle pretty much balances out that. And so what we'd expect now is that we've satisfied the buy side and we're going to be seeking sell side liquidity. And you can see in the process of this, quite powerful up close candle, we've created another volume imbalance here. So we'd be expecting price to seek out that volume imbalance and balance that out. So we'd be looking for price to draw towards the sell side liquidity residing at the low of this daily candle, and then into the volume imbalance just here. And so our bias going into this session would be bearish. So we've zoomed into our 15-minute chart now on the 24th. And again, there's a lot going on. So I'll just step through what we're looking at on the chart so we can orientate ourselves before we start framing out this particular trade. So we have our midnight open here, and then obviously extended out in time. We have our 8:30 open, and again extended out, and then our equities open here at 9:30, extended out. Now, if we zoom out a little bit, you can see we have this opening gap here from the Monday. So there's a gap here from there to there. We've marked that out in time. We have that volume imbalance that we were talking about on the daily chart. So you can see that here. And so we've effectively got another opening gap there as well. And then sitting below us, we have this fair value gap just here. You can see this is from the 20th of May. So this was in that run up higher. And so you can see that extended out in time here. And so you can see as we come into the 8:30 open, you can see we dip below the midnight open. We trade up high. We create these relative equal highs here. The market dips back down. We don't quite take out this buy side liquidity up here as we come into the equities rotation. But you can see the market, quite aggressively sells off. We take out this sell side liquidity, these relative equal lows, and you can see how this volume imbalance, this opening gap, is acting like a magnet to price, so it's drawn it down. And you can see even here actually, as we've come into the opening of the market, you can see this has almost acted like support, this volume gap just here. So it's bounced off that, traded higher, then been sucked into it. You can see we've traded straight through that. We've gone down into that fair value gap, that bullish fair value gap that we drew across from the 20th. You can see we just wicked into that. We react to that level and immediately start trading higher, again being drawn back into that volume imbalance or that opening gap. We trade above it, again get sucked back, and you can see in the process of this rally higher, as we sort of rebalance this range, you can see we have these order blocks which act as support as the market then rallies into the end of the session, and then targeting that opening gap that we talked about here from the Monday. So let's zoom in now to our lower time frames and start framing out our trades for this particular session. So we've zoomed into our 5-minute chart now, And really what we can see is we've got that opening gap or that volume imbalance here, which is in gray, which is just sort of drawn across. And you can really see even on this 5-minute time frame, how price has just, oscillated around that level over the course of the session. Now, obviously going into this particular session, we had a bearish bias, so we were looking for a sell setup, and that's exactly what we got just after the 8:30 open. So you can see we have our bearish fair value gap, which is set up just here. And now this is, immensely precise, because you can see that the low of that candle, so it's our 3-candle formation, so 1, 2, and 3. So the low of that candle precisely matches with the level or the high of this candle as we trade back up into that fair value gap, that bearish fair value gap, and you can see the market then aggressively trades away. We get sucked into that volume imbalance before targeting that bullish fair value gap that we have down here. Now, this particular fair value gap would be quite tricky to see just because it is so narrow, but you can see it fulfills all of our requirements. We didn't quite get the sweep of the buy side liquidity relative equal highs you ideally would have wanted to have seen, but you can see this run high would have taken out all the buy side liquidity here. We get our break-in structure just here, so we get this displacement down in this particular move here, and again our trade up into our fair value gap before the market then aggressively trades lower. So after the initial opening rotation, and we obviously have this short position that we've taken here, and once the target's met at this bullish fair value gap down here, you can see that the market is pretty sloppy, it's chopping around. We consolidate at this level here as we go into the lunch period, and then as we mentioned before, that volume imbalance acts like a magnet to price. You can see that price trades back up into it. We overshoot a little bit, we rebalance this dealing range again, and we actually trade up into that fair value gap again before then being sucked back down towards that volume imbalance. And you can see we oscillate around it again, trading back into it here. So it almost acts like support and resistance over this particular session before then racing away, and at the end of the session targeting that opening gap that we talked about earlier in the video. So it's not really until the afternoon or the PM part of the session that the direction becomes clearer and we'd be more confident in taking trades to go long. And you can see we would have done that through a number of ways. So we have these order blocks here, even here, and here, which we could have used as potential entry mechanisms to go long into the PM part of the session. Now, I personally probably wouldn't take this one because it's before lunch, but certainly these ones after lunch would be ones that I'd be looking at. You can see we have this one here at 1 o'clock, and certainly this one here just before 3 o'clock would probably be the one that I'd be looking for. This is that hour of power that we talked about in the last lesson. So you can see this would be just after 3 o'clock that you'd be getting set off this order block here, and then targeting this, retrace back into that opening gap towards the end of the session. But finally, what we're going to do is zoom into our 2-minute chart now and look at some of the tighter executions we could have taken during that opening rotation if we're looking for, a tighter entry and a better risk reward. So that initial trade that we're looking at on the 5-minute chart, you can see we have a confluent fair value gap just here on our 2-minute chart. So again, exactly the same setup. We have our 1, 2, 3 candle formation. You can see we sweep the buy side liquidity just here before the market reacts to this break-in structure we have just here. So we have a little swing high just here before we trade lower. And you can see the market then trades back up into that bearish fair value gap a number of times before breaking down, trading towards that volume imbalance and lower down to that bearish fair value gap. We also have another small opportunity just here again on this 2-minute chart. So after we wick into that fair value gap, you can see we get a little bit of a displacement. We break market structure just here before we trade back up into that, and then we trade lower again targeting that bullish fair value gap just down here. And so you can see there was 2 possible entries we have here using the mentorship model from 2022 that would have been in line with our bias, and targeting a fairly obvious run on buy side liquidity down to that bullish fair value gap. So we can see this particular session on the 24th presented us with 2 potential entries using the mentorship model to go short, and then targeting the sell side liquidity down here using this bullish fair value gap as a target. Thanks for watching my review of lesson 33 and 34 of ICT's 2022 mentorship program. Today's video showed there's always something to learn. Personally, the reminder around how to use dealing ranges and how the opening gap can act like a magnet to price were particularly handy. So if you found the video helpful, it would be great if you could like it, because that will help other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. And lastly, if you'd like to hear more from me and join a community of like-minded traders, then check out the link in the description, which allows you to subscribe to my free weekly newsletter and to join our Discord. Thanks for watching, and I hope to see you next time.